All right. Okay. All right. Let's continue with the questions. I hope we are done with the completeness.
Yes, please.
Okay. So let's go to the next one, which is the neutrality. So if they say the financial statement or financial information should be neutral, or accounting information should be neutral, what do they mean? Neutrality. What is the meaning? Neutral. What is the meaning? The financial information should be neutral. Yeah. Senior, round it up.
Yeah, so when we talk about neutrality in accounting information, um, it means that there should be no bias in the selection of presentation of financial information. It should be free from errors.
Okay. All right.
Yeah.
Okay. All right. That is cool. That is cool. Okay, Senior Edwin, do you have something for us on the
Okay, so with the neutrality, I think that financial information should be made without being biased in your processes. That the information shouldn't be manipulated in a way that will favor a group or influence a decision and affect another group or something.
Okay. All right. Thank you. Thank you. Senior Wafa, neutrality. What do you mean by neutrality? What do you mean by neutrality? Okay. All right. Yeah. Senior Seda, neutrality. If you say neutrality, what do you mean? Auntie Annabelle, neutrality.
Okay, so with the neutrality, it means with the financial statement, there should not be biased in their presentation. It should be free from errors and it should be stated as it is. It shouldn't be biased to favor one party and not favor one party.
Okay. 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 That is cool. Please, this particular topic, the overview is 10 marks. Is 10 marks. So let's take everything seriously. Let's go to the question 2. Let's go to the question 2. Describe 5 main elements of financial statement in accordance with the what? With the International Accounting Standard Board's conceptual framework. So 5 elements of financial statements. What are the elements? The element of financial statements. Please, what are the elements that we have? Yeah. Yeah, Ofa, your hand is up.
Okay. We have the balance sheet.
Element.
Let me check.
Yeah, it's in a gospel.
So is it the assets and the liabilities?
Exactly. Those are the things that you can see in the financial statement. The composition of the financial statement is what we call the elements. Okay. So those are the assets, liabilities, equity, income, and what? And expenses. Okay. So please know that from today, the elements are the items the main items that comprise the financial statements. All right, now Mike.
I'm the one who answered. I just changed my name.
Okay. So they say you should describe. You just have to say the meaning. If you have any examples, you add it as well. Okay. Let's come to this one. Okay, let's come here. The conceptual framework for financial reporting is a set of principles which underpin the foundation of financial accounting. The conceptual framework sets out the going concern concept as one of the important underlying assumption of the preparation of financial statements. Explain what is meant by what is meant by the assumption that the entity is operating under going concern. Support your answer with a suitable example. So going concern, if they say a company is operating under going concern, what do we mean? Yeah.
Say. Oh, sorry.
Yes, now what part?
Okay.
Yes, now for your hand is up. And Sinaidu, your hand is up.
It
Okay,
means that
so
the company is going to be still to the foreseeable future.
Okay. Sinaidu, Auntie Annabelle.
Say, it also means that a company is not going to liquidate or go into liquidation for about a period of time, a long period of time. So that's like they're going consider a foreseeable future.
Okay. Yeah, Sinaidu. Sinaidu, your hand is up. Or is the old one? Now, Mike, the entity is operating under the going concern concept. What is meant by the assumption that the entity is operating under the going concern concept? Okay. If they say, okay, so now Mike.
My understanding is that the enterprise or the entity will continue to be in operational existence for the foreseeable future. That's the preparation of account. There's no one assumption that accountant makes, and then accountant makes, and then that of the business will continue to operate for indefinite, or let's say for future indefinite period.
Okay. All right. So the going concern itself means that the entity is going to be in operation. The entity does not have any intention of closing down its operations. If we say that the entity is operating under going concern, it means that the entity is operating with the mindset that they will be in operations for the foreseeable future. So whatever balance that they are going to have, whatever balances that they are having, they are taking it to the next year, and their assets and liabilities are also measured at either replacement values or replacement costs. They are not using, or they are not valuing their assets and liabilities at the breakup value. The breakup value is if the entity want to stop operating right now, what is the amount that they can realize from the sale of what? The assets. So they are using either replacement cost, they're either using fair value to value their assets, or they are carrying their assets at historical cost. So the entity is operating into the what? Into the foreseeable future. There is no sign of the company is operating. They are not preparing their financial statement on breakout values. They are preparing it on the what? On the going concern what? Concepts. Okay. So the example will be, the practical example or the suitable example will be, the company has receivables of 10,000 from last year, and the receivables has been shown as a balance in the what? In the current year. That shows that the company is operating under the concept of what? Going concern. But if the entity is not operating under the going concern, it means that the entity will be having receivables, but they will now be finding ways to what? To sell the receivables, or they will disclose the receivables, or they will sell the receivables, or they recognize the receivables at their breakout values, meaning that that is the amount that they can realize from what? From the receivables. Okay, so that is meant by the companies operating under the breakout values or under going concern. Let's come to the other question. Okay, one of the fundamental qualitative characteristics of useful financial information in the conceptual framework for financial reporting is faithful representation. Explain what is meant by faithful representation. What do we mean by faithful representation? Faithful representation. Yeah, answer another.
Teaching means that an accounting information or financial report by a company or someone should be complete, neutral, and free from error.
Okay, 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 that is fine. That is fine. Senior Mike, faithful representation, what do you mean?
I think that's the explanation analogy. It
Really?
should be free from errors, and then it should be neutral.
Okay, okay, okay. Let's take the 6. Okay, I hope you can give the difference between financial accounting and management accounting. We have done
Yes,
this.
please.
We have done this twice. We did it in financial accounting, and we have
Yeah,
done
please, yeah.
and we have done that in management, include to management accounting too. Let's come to the last one. The ISB conceptual framework underpins what IFRS say and why they identify a particular accounting treatment. Another important aspect of the conceptual framework is an attempt to define high quality information in other words, what makes financial information useful. Explain in accordance with the International Accounting Standard Board's conceptual framework, the enhancing qualitative characteristics of useful financial accounting information. What do you mean by enhancing? Yeah, Sinasadin.
Okay, so with the enhancing qualitative characteristic, it differentiates a more useful information from a less useful information. But with the useful financial accounting information, it's like differentiating what is useful from what is not useful. Yes. With the enhancing, it's like emphasizing on the usefulness, whether although they are all useful, but one is more useful than the other. It's like ranks. But with the useful financial accounting information, it's just like this is useful and this is not useful.
Okay. But the question is only about the enhancing. So don't bring in the
Enhancing. Okay.
the fundamental.
Okay.
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 So
Okay.
what do you think is another thing that you can add to this to you can add to answer this question?
So I think we can bring the comparability, the verifiability, the timeliness, yes.
Exactly. So those things must also
Yes.
be what? Must also be added. But you can add this looking at the marks. If they ask you this question for
Okay.
10 marks, then it means that you
Okay.
have to explain those, you have to bring those enhancing characteristics also.
Okay. Sure.
Okay, explain in accordance with this one, the enhancing qualitative characteristics also. So you are explaining all. They are asking you to explain the comparability and those ones. The enhancing is not explain enhancing qualitative. No, if they say enhancing qualitative, then it means that they are talking about the word enhancing itself. The enhancing qualitative characteristics of useful financial accounting information. So I'm sure this question will be like 10 marks or something. So you have to explain those issues. Okay. Let's talk about books of original entry. Let me do the intro so that next week we just come with the what? With the calculations. Okay. So let's I'm just praying that within 2.5 months we should finish the syllabus so that you can go and do your individual studies, and I will also take you through some revisions again. Okay. So let's come to what we call the books of original entry, or subsidiary books, or prime books. Okay, so they can also be called the subsidiary day books, or they can also be called books of prime entry, books of original entry. So they can also be called the subsidiary day books. They can also be called the books of prime entry. Okay. All right. We all know that whenever a transaction happens, it should be taken to an account. Okay. But these transactions, or we know that in accounting, in every business, transactions happen on daily basis, and you can look at the volume of the transaction. Just imagine that anytime that you come to work, you sell about 20 billion worth of items. If you should be sending these items to their accounts every day, you see that the account, like the book that you are going to be using for the account will be too much. Because these transactions are happening every day. So if you should be entering this or taking this into the ledger on daily basis, the ledger will become bulky. It will be too complicated. So what do? Let's now have a place where we can summarize all the transactions that happen within the month or within the day, so that we can just transfer the total. Not that we have to, okay, the thing happened this particular day, this date, so we are sending it one by one. No, we can just have a book that we put those things there. That's why at the workplace, you have a small paper. If you are selling, you have a small paper. Then you be putting the thing on the small paper. After you are done for the day, then you total it and go and enter it in the books that you're supposed to enter. The paper that you are using, we can say, is a books of original entry. So where those day-to-day transactions will be recorded before we transfer the whole amount to the ledger. So we have the books of original entry as a result of how transactions happen during the business on day-to-day basis. If we should be recording them direct to the ledger, it will make the ledger too bulky and too voluminous. So how do we avoid that? Let's now have a book that we can summarize, or we can record all those day-to-day transactions, total them, and just send only those figures to the ledger. So if it is sales, let's have a book on sales, which we can record all the sales for the day. And at the end of the day, we just total it and send the the total amount to the sales accounts. Okay, that will be fine. But if you should, okay, you sell something 20 Ghana, you go to the sales account and put the 20 Ghana there. 30 Ghana, you go and put the 30. No. It is going to be time wasting and also going to be wasting our books. So just put all the transactions somewhere. At the end of the day, total it and send it as the whole amount to that particular place. So the books of original entry are the books in which the first transaction are entered, or is a book that is used to summarize transactions and the total being sent to what? To the ledger. So the books of original entry are just there to record those day-to-day what transactions. And at the end of the day, we transfer the total to what? To the respective ledgers. Okay, so basically you will see that in business, the company will be selling, the company will be buying, some of the people will be returning their goods, and some of the company will also be returning their goods to what? To wherever they are buying the goods from. And some of the customers will also be returning the goods for 40 and all for because the goods are 40 or something like that. And the company can also be buying assets on credit, and it can also be receiving cash from the customers. How do we go about these ones? So you see that the company will be selling, the company will be buying, the customers will be returning some of the goods, the company will be returning some of the goods to the suppliers. The company can also purchase assets on credit. The company can also buy the goods on credit. The company can also buy the goods on cash basis. So where do we record these transactions before we send the whole amount to what? To the respective ledgers. The company can also be incurring some petty cash expenses. Maybe electricity, the company will pay water bill, they will pay, there are some items that will be happening on daily basis. How do the company go about it? So those transactions will first be entered in the day books before we transfer them on monthly basis to what? To their respective ledgers. Okay, so we are looking at the day books. What are the day books that we have? What are the various day books that we have? Okay, and we also call something, if you want to record transaction, in the cash book at the workplace, what are you going to see before you go ahead to what? To record a transaction in the cash book at the workplace. If you want to record a transaction in the cash book, what are you going to see? What will tell you that, okay, the company has actually paid this particular amount of cash, so I should record the cash. What are you going to see?
The receipt.
Okay, so you'll be seeing the cash receipt, isn't it? Okay, before you can also recognize purchases, what are you going to see? If you want to recognize purchases that the goods has been received from the company, okay.
Invoice.
Okay, you will see the purchases invoice. So you see the invoice, or sometimes you see the dispatch notes that the supplier will be sending to you. You can also use that. So we use the purchases invoice. So these are the documents that you can base on and record what transactions in the day books. So we call them source documents. What are source documents? They are items that give evidence of what? Business transactions. They are items, or they are books, or anything that gives evidence of business transaction is what we call the source documents. Okay, so let's look at the day books first. What are the day books first that we have? We have the sales day book, or the sales journal, sales day book or sales journal. So we have the purchases journal, or the purchases day book. We have the sales returns, which is what we call the return invoice. Okay, sales returns journal or day book. Okay, or it is also called return invoice. Okay, so the company has sold to their customers and the customers are now bringing the goods. So they are bringing the return in. So return inwards. Okay, because we also have what we call the purchases what? The purchases return journal. Okay, it is also called return outwards. The company is returning the items that they bought to their respective or to the supplier. So it's also called the return outwards. Okay, then we also have what we call the journal or the general journal. The journal or journal proper or so let me just say the general journal. It is also called the journal proper or the journal. Then we also have the cash book. The cash book is a multi-purpose book. It serves as a journal at the same time a ledger. Okay, so the sales journal, what do we record in the sales journal? You see that when sales are made on cash basis, it should be recognized in the cash book. So the question now is, if sales or when sales are made on credit basis, where do we recognize it? It should be recognized in the sales journal. So the sales journal recognize what? Credit sales. So whenever you sell on credit, then you are going to recognize in the sales journal. Okay, let's come to the purchases journal. What will be recognized in the purchases journal? What will be recognized in the purchases journal?
Credit purchases.
Okay, credit purchases.
Purchases.
Okay, so credit purchases. Okay, what about the sales return journal? What will be recorded there?
The return inwards.
Okay, so goods returned from what? Customers.
Yeah.
Or goods returned by customers will be organized there. The purchases one will be that goods returned to what? To the suppliers. Okay. Okay. The general journal will recognize any other thing apart from cash, which is not recognized in any of these books. So the general journal recognizes other transactions such as purchase of assets on credit, sale of assets on credit, bad debts, and it also recognizes the opening and closing balance of the company. So any other thing that is not recognized in the sales journal, in the purchases journal, in the sales return journal, in the purchases return journal, in the cash book, that particular item will be recognized in the general journal. And the cash book, we have a single column cash book, we have a double column cash book, and we have a 3-column cash book. So the cash book, if it is a double column cash book, we have both the cash and bank there. So the cash book will record the receipt of cash and also payment of cash or check if it is double. Okay, so receipt and payment of what? Cash. All right. The question now is they can ask you what we call source document for each of them. So let's look at the journals and their source documents. So let's look at the journals and their source documents. So where do we get information before recording the transactions in the journal? Okay, so where should get the information before, or what will give you the proof that this particular transaction has happened is what we call the source documents. Okay, so the sales journal, what we use is a sales invoice. So the company will give an invoice and we can use the invoice. If you come to the purchases journal, we use what we call the purchases invoice, or someone can also see purchases journal. We use the purchases invoice, or someone can see the delivery notes given by the supplier to the customer or to the company. So we use the purchases invoice. Okay, If you come to the sales journal, it depends on who is what, who is issuing the what, the 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 documents. So we'll be looking at, okay, so the sales journal, it depends on who is issuing the what, the notes. Depends on who is issuing the notes. If it is the company that is issuing the note to what, to the customer, you see that whenever company sell goods to the customers, although we haven't done the double entry, but we know that whenever sales is made on credit, the company's goods will be going out. Okay, so the inventory will be reducing. So we credit the sales to reduce the inventory, and we debit what is coming in, which is the receivables. That your company will now be receiving money from what? From the people, and that is an asset. Okay, so we debit the receivables and we credit the sales. Okay, if the goods are being returned, assuming you are owing me 2,000, but you have returned 200 of the goods, how much are you owing me now? You are owing me 2,000, but you have returned 200 of the goods that I've sold to you. How much are you going to be owing me? How much are you going to be?
1,008.
Okay, 1,008. Okay, but this your amount is being debited in my account. So if I want to reduce it to 1,008, it means that I have to credit your account. Okay, so the company can issue what we call a credit note to the customer, telling the customer that, okay, your account has been what? Has been credited. So the sales journal, we have what we call the credit note. Okay, so if it is the company that is issuing the note, then the company will tell the customer that, okay, your account has been what? Has been credited. So debit our account there. But if it is the customer that is issuing the note to inform the company that we have returned the goods, then the customer is going to issue a different note again. Okay, the company is a creditor to the customer. The customer is a debtor to the company, but the company is a creditor to the customer because the customer is owing the what? Owing the company. So the company is a creditor to the customer, and the company will be having a credit balance with the customer. So whenever the customer returns the goods, it means that the amount that the customer is owing the company will reduce. So the customer has to debit the company's account in his books. So the customer can issue what we call a debit note to the company by telling them that, okay, we have debited your account, so you should also what? Credit our account. So for the sales journal, it depends on who is issuing the what? The note first. So if it is the company will issue what we call a credit note, telling the customer that we have what? Credited your account. So debit our account. Okay, the sales return journal. This will be sales return journal. Okay, we also have the purchases return. We also have the purchases return journal. The purchases return journal also depends on who is issuing the notes. If it is a company, the company will issue debit notes because the supplier will be a creditor to the company. So the company is returning to them. It means that the amount that the company will be owing them will be reducing. Okay, but if it is a supplier that is issuing, the company is a debtor to the supplier. So the supplier is going to credit the company's accounts. Okay, let's have the cash book. Let's have the cash book. So the cash book, we are going to be using the cash receipt. We are going to be using the check if it is. We are going to be using the check. We also have payslip. We have so many documents that we can use to record a transaction in the cash book. Basically, you'll be seeing the cash receipts and also the check. So we can use the cash receipt. cash receipt, check. We also have what we call a check counter flow to recognize what a decrease in whenever you are going to be paying. So we use when payment is made out of the bank, we use a check counter flow. So you also will be using payslip, but these are the ones that you see. So the general journal, what are we going to be using? Okay, the general journal, you can also use maybe the asset register. You can also use the sales invoice for the asset or the purchases invoice for the asset, because it's going to be recognizing a sale of asset on credit and also purchase of asset on credit. So we can also get the document relating to the asset, and we can use that one to record that particular transaction there. So they can ask you the source document. You have to You have to be able to come with it. Please, sales journal recognize only credit sales. Purchases journal recognize only credit purchases. Sales returns recognize what? Goods that are returned from what? From the customers. Okay. Purchases return are returns that are or the goods that have been returned by the company to what? To the suppliers. Cash book recognize what? Payment and receipt of cash. The general journal recognize any other transaction that is not recognized by these 5 books. So basically, it's recognize the credit disposal of assets on credit and acquisition or purchase of assets on credit. Also, if you have opening balances and closing balances in the books of the company, it is the general journal that is going to be recognizing those issues. How do you prepare the sales journal, purchases journal, and sales returns journal? And you can see that sometimes a company can sell and say they are going to give a discount. Xmas time like this, or the past Easter time, companies normally give discounts. If the goods are sold at a discount, the first question that you have to ask yourself whether it is a trade discount or a cash discount. If it is trade discount or cash discount, how do we go about it? We look at that one later, but let me give you how the sales journal, if you are asked to prepare sales journal or purchases journal, this is how it will look like. So you have the sales journal. You have the sales journal. So the first thing that you have is that you have the date. When are you selling? The date is very important. So you also have the details. The details has to do with the item that you are selling or the particulars. So maybe you can look at the amount or the units, or sometimes we look at the invoice number here. Or sometimes you see ledger folio. The ledger folio, we normally use it for what? For accounts. The ledger folio will tell you the corresponding accounts. So on what page of the corresponding account can we actually get this particular transaction? So if you sell to someone on credit, you'll be having debtors and and sales. So if in the debtors account, you can ask yourself, in which page of the sales account can I locate this particular transaction? That is what we call the ledger folio. So most of the time we use a ledger folio for what? For the account or the ledgers. Okay, you can also have what we call the amounts here or the unit. Sometimes it can be the units or how much unit are you selling, or you can do the amount together here. Then there can be a discount. So you put a discount amount here. Then you now put a total here. Okay, so let's take example here. Assuming on January 1, the company has sold 200 units of item at 20 Ghana cedis to Kofi on credits. Okay, at a discount of, at a trade discount of 10%. Okay, so this is a credit transaction. This is a credit sale. So we have to recognize these in in the sales journal. Okay, so the date is what? What is the date? Seniors, what is the date?
First January.
Okay, so we have the 1st January. So we have the January 1. Okay, the details. What are you going to put there?
200 units, 20 cities.
That you can sell 200 cities to a lot of people. So you can put quotes there. Okay, so if you put a name there, the name will be very important because you can sell 200 cities to a lot of people. Okay, so you can say sales to Kofi or Kofi into bracket 200 units. But normally we put the name of the person there, Kofi, details, Kofi. Okay, let's come to the invoice number. Let's assume that it is the invoice number is XL001. Okay, so the units. So the unit and then
200.
so we are selling 200 at how much?
20 cities.
Okay, all right. So that will give us what? 4,000 Ghana cedis, isn't it?
Yeah.
Okay, but there's a discount. There's a trade discount of how much?
10%.
Okay, so how much will be the discount? How much will the person be paying?
Okay, so 4,000 minus 400.
3,600.
Okay, so you can put 4,000 here, then you put a discount of 400 here, isn't it? Then you count
Yeah.
the net
Yeah.
amount as 3,600. That's how we go about it. The purchases journal also follows the same format. The return invoice doesn't have the discount. The returns doesn't have the discount column, but they all follow the same format. But the cash book and the general journal, they have a different format. So what we'll do is that I'll bring a question for next time so that please I want us to move like fast. There are certain things, the topics that you are going to see in the exam, whether you like it or not. I want us to focus on those ones. Yesterday I should have informed you guys to come and join the interpretation class. Yesterday I taught the financial reporting and corporate reporting people interpretation of financial statement, which is also 20 marks for you people. Okay, I should have just informed you guys to join, but don't worry, we'll still look at it. So I want us to move through the sales journal. You can see a question on it for 10 marks. They brought it before, so you should not be there and be saying that it won't come. They brought it before and they can still bring it. So I want us to finish this one. We've also finished what we call the double entry, which is the account. We finished that one. Then we now move on to depreciation and those prepayment and those ones we deal with them. Then we now focus on partnership accounts. Then after partnership accounts, we can move on to control account, how to prepare trial balance and those ones. Okay. After that one, then we know that, okay, things that are left will not be plenty. All right, seniors. So I just want you to have the day books, what they are used for, what they record, what are their source documents, what is the format, and how do we go about it. All right, so we have 5 minutes remaining. If you have any issue, you can let us know. You can let us know so that we see what we can do. All right. There's any issue or we are okay? Are we cool?
Yes, sir.
Okay. So I'll see you guys on Sunday. Those that are doing intro to management accounting, I'll see you guys on Sunday. But those that are doing financial accounting, I'll see you guys on Tuesday. All right. Thank you all for coming. I'll see you guys.
Thank you.
All right.